touches nearly every major financial decision in this country, and most of the conversation about it happens without the people who actually build it in the room. That changes today. Welcome to the FICO Score podcast. I'm Kristina Robinson, Director of Communications for FICO Scores. So, for our very first episode, we're talking about all the topics the industry can't stop talking about. And for the answers, we have Julie May, the Vice President and General Manager of B2B Scores at FICO. From her path to leadership, what's missing from the headlines, AI's real impact on credit scoring, and where credit scoring goes next. Nothing is off the table. Julie, welcome to the podcast.
Well, thanks for having me, Kristina. I'm so excited.
Julie, let's start with you. You've actually been at FICO for more than 20 years. Talk to us about your career journey and ultimately what led you to leading the B2B side of FICO Scores.
Yeah, so right out of the gate, just aging me, Kristina. Thanks for that one. No, I've been incredibly lucky to have had a very long career at FICO. I think people are, very familiar with FICO because of the FICO score, which is the business I lead now from a B2B side perspective. But maybe people are not as familiar sometimes with all of the other things that FICO does. We have a very significant enterprise software side of our business that's known today for the FICO platform. But within that business, we have a lot of different solutions, including scoring solutions that solve a lot of real world problems for financial institutions to let them solve problems for their consumers. And so I spent about the first 17 years of my career at FICO on the software side of the business. And prior to that, I'm really going to age myself now. I spent many years as a client of FICO using their technology. And so when I joined FICO, I already knew the transformation that FICO could have in a business because I used it in a telecom business that I led. I used many different solutions from FICO in that telecom business, and I could see how it transformed our ability to do things at that telecom. And so it led me to actually be interested in working for FICO, and that led to 20 plus years of different roles and responsibilities and doing different things at FICO. So it's been an interesting journey for sure.
When you talk about transformation, it's interesting because I think of the transformation that the B2B FICO Scores team went through once you took over as the VP and GM. You've built quite the incredible team. What do you think is kind of the key to building that all-star bench of a leadership team that now is the FICO Scores leadership team?
Yeah, so what I would say is I inherited an incredible bench of leaders when I took over the role that I now have at FICO. So I was very fortunate to basically join a team that was filled with tremendously smart and dedicated individuals. And then we were able to grow that team. And so one of the things that became very clear to me when I joined FICO is that, we have a high performing organization. Fun fact, I actually left FICO for a little bit.
A
What they
boomerang.
call a bounce back at FICO. And so I left and went and did something else about halfway through that 20 plus years for a very short period of time and realized that I just missed the people at FICO and I missed the quality of the intelligence. I missed the quality of the challenge that everyone puts on each other within this organization. We have a very, very, very special culture. But I would say that the culture in Scores is really interesting. It's a very collegial culture. I noticed that right away. And one of the things that the people who had long been contributing to Scores told me when I joined this side of the organization is that culture was incredibly important to them. So as I continued to build out the team and grow the team, which we've done rapidly over the last couple of years, and we've really scaled the organization on the Score side, it was important to me to maintain that culture. And what I think is particularly critical in that culture is also critical associated with the products we deliver to the market. And that is the ability to trust, right? So at the end of the day, I want to build a team that's filled with leaders who can trust each other to challenge each other and to deliver what they say they will deliver. And at the end of the day, the FICO score needs to be delivered to our customers in a way that they can trust it and that they can, use it, having that confidence from a market perspective. So I really think there's an interesting parallel associated with the people that I look to hire into leadership positions in the FICO score business, or that I continue to, promote within the FICO score business, help enable those characteristics. And those are characteristics we have to deliver in our product to the market too.
And one last question on this. As I work with the team every single day, one of the best parts about it is that we have people from all walks of life that have been truly in the fields that they are now supporting from the FICO score side, from actually on the lender side or deep in the policy world, right? We have folks from all walks of life. And I think that is a very unique part.
Yeah, I agree with you. It's been one of my major goals when I joined the Scores organization is to really build a team that had their feet on the street, so to speak, right? And so I came to FICO as a user of FICO tools, solving problems in a business. The business I was in was telecom. We serve telecoms, we serve financial institutions, we serve all different types of institutions, but the way you do that best is by really having sat in the seat and deeply understanding the challenges. My background is also in product management primarily, and we always used to say, what is stated is often not what the true problem is. So you kind of have to dig deep. And I think people who come from the industry, who support our clients, can have an ability to just dig really deeply. So we've really focused on finding people who were in underwriting functions, who worked on the securitization side of the mortgage or the ABS market side, people who worked at the GSEs, people who worked in insurers, people who were focused on capital markets. These types of wide range of experience in our FICO team help us better serve our customers who are using the FICO score across all of those different types of use cases. And so that's been a really core focus of the build out of the team over the last half decade.
Let's switch gears a little bit. Let's talk about our customers, right? When you talk with lenders today, what is keeping them up at night? What problems are they trying to solve, especially when it comes to credit risk and underwriting?
I think at the end of the day, they're trying to provide credit and they're trying to provide services and products to their end customers, and they're trying to do so profitably. At the end of the day, that's what our customers are doing. They're trying to serve their customers. They're trying to do so making good risk decisions. And they're trying to do that because they want to actually operate profitable businesses, right? Macroeconomic conditions always have impact on their ability to do that. We see tightening credit boxes, we see increased default trends across different lines of business associated with our customers. But the thing that remains consistent is every single one of our lender partners wants to responsibly serve their customers, and they want to try to expand their ability to serve those customers. And so our goal is to try to build products and solutions that enable them to do that.
When you talk to lenders right now, a lot are focused on financial inclusion, right? Is it about having a more predictive tool or is it having a more inclusive tool, or do those truly go hand in hand?
I think they can go hand in hand. What we say is, scoring more isn't scoring more better. Our goal is always to score people fairly and accurately, to remove bias from the system, to enable our customers, the lenders, to provide more products and services to their customers at better rates, right? What we want to do is we want to enable the best risk prediction, to enable our lenders to provide the best product at the best price to their customers. And so simply providing a FICO score on a consumer doesn't meet that objective. We have to be able to provide FICO scores that are accurate, that will help our lenders manage their risk profile and provide the best price for that product to their customer. And so when we look at building our solutions and we look at enabling us to help our customers expand their credit box, we do so by looking at all of those goals together. And so we call that scoring more consumers better. And we have a lot of tools and capabilities that we've introduced into the market to enable us to help lenders do that. Some of the recent ones are the introduction of FICO 10T. FICO 10T, the T in 10T stands for using trended data from the credit repositories to provide an improved risk prediction to our lender customers. It also enables us to actually move more potential borrowers into qualification score threshold areas so that our lender customers can approve more borrowers for their products and lending lines. And then another option that we have available here is our Ultra FICO score, which helps us augment the data that we receive from credit reporting agencies with cash flow data, which just provides us another perspective of what a borrower looks like when that lender is making a decision in terms of whether they're going to provide them that product or not.
Now, we promised candid, so maybe a little bit of a spicier question. I know you love those.
Oh, yes.
Let's talk about a point that specifically is brought up, perhaps by the fintech world right now. Sometimes credit scores, particularly, they refer to them as traditional credit scores. Some have painted them to be, and I quote it, incomplete. Julie, how do you respond?
Yeah, I mean, what I would say is the FICO score is not the only piece of data that's used in making a lending decision. That's not the way that the lenders use the FICO score. The lenders use the FICO score to be the best standard and consistent measurement of risk associated with making lending decisions and communicating those lending decisions to regulators and to investors and to others in the ecosystem. And that is the goal of the FICO score. Can the FICO score be augmented with additional data to enable you to make decisions using the FICO score plus additional data? Not only can it, but it should be used with other sources of data to make decisions. And in the vast majority of cases, lenders are doing that. So we actually encourage that. That's the way that lenders use our product and tool. And nobody has represented the FICO score as using every element of data that's available. But it does use the data that enables us to provide a score that provides the most stable, predictive, standard measurement of borrower risk over the longest term. That's the benefit and the differentiator that the FICO score has against other types of data that aren't standard and that have different types of biases that they introduce into the system. And so, like, we see this when we look at cash flow data, right? FICO was a pioneer in looking at cash flow data in terms of credit risk assessment. We did that with the introduction of Ultra FICO almost a decade ago, right? That was our first introduction of looking at cash flow data. But cash flow has some bias, right? There's an opt-in element from a consumer perspective associated with cash flow data. So when we compare cash flow only data with credit bureau only data versus cash flow plus credit bureau data, what we see is you can get the best performance with both together, but you get the most standard long-term performance between cash flow or credit bureau only with credit bureau data, because it doesn't have some of those bias elements that you would have with only cash flow. But again, it doesn't mean, just like I said earlier, that cash flow data can't be very valuable in an underwriting decision. In fact, it can be very valuable. And that's what we see when we look at the performance of Ultra FICO in the marketplace, right? We can see that for those near prime borrowers who represent positive behaviors from a cash flow perspective, you can really drive an increase in approvals by using Ultra FICO in addition to the classic FICO scores.
So, is it true that, from your perspective, cash flow plus credit bureau data, which equals Ultra FICO score, is the future of credit scoring?
I think it's one of the futures of credit scoring, right? I think at the end of the day, the core FICO scores, whether they be FICO 8, FICO 9, FICO 10, FICO 10T, provide a very stable, trustworthy risk assessment for all different types of industry stakeholders. And those have a very important place in the market. I think that in addition to things like Ultra FICO, just provide another metric that lenders can use to help improve decisions that they make for borrowers.
And ultimately, that's what the credit score, that's what the FICO score was invented to do, right? Answer one simple question. What is that?
It was meant to answer one simple question, which really is, what is the likelihood or what's the propensity of this individual to default in the future, so that lenders can make the best decisions and price the products the best for the borrower community. And it was really built with this premise that we need to remove bias from the lending decision. At the core of, the founders of Fair Isaac, FICO, right? Bill Fair and Earl Isaac, it was about removing bias from lending decisions and making it more seamless and improving, the quickness of decisions as well. And so if there's one thing that I think unequivocally FICO has achieved, it is that removal of bias and really streamlining the lending information sharing across all of the stakeholders in that ecosystem.
Now, we've touched upon FICO Score 10T a couple of times in this conversation, and arguably no other industry is talking about credit scores as much right now as the mortgage world. A lot happening there with the credit score modernization effort. Julie, walk us through from FICO's point of view, where are we right now?
There was a credit scoring initiative, right? It was initiated by Congress that the GSEs needed to look at competition in the credit scoring market, right? And they reviewed and analyzed different submissions from different providers of their credit score products. FICO actually submitted multiple different models into that process, and then others did as well. And out of that process, the GSEs, the government sponsored enterprises, actually recommended our newest, latest, and greatest score, FICO Score 10T. Right. Again, that T in the FICO Score 10T stands for trended data. So we actually look at people's behavior over time versus a snapshot in time. And that trended data became available as a data source across all three of the National Credit Repository agencies in 2011. So the reason that FICO Classic, which is the score that's in use by the majority of the mortgage industry today, did not have trended data in it is that when that model was built, trended data was not available to build that model on, right? Another thing that 10T data has in it is rental data. Again, rental data was not available when we built FICO Classic, which is the model that is used by the majority of the mortgage industry today. And it still is not that significant in the credit repositories, right? The last analysis we did said that about 3.2 million of the 80 million renters have their rental information available in the credit repository information. That said, we think rental data is really interesting. It's why it's not only in FICO 10 and FICO 10T, but why we introduced it in FICO 9 over a decade ago, because as that rental data grows, it's an interesting data element to enable lenders to review a borrower's capacity to pay, right, and ability to pay. And so we find it to be a really interesting data point. And that's another thing that is, of course, included in 10T as it was in FICO 10 and FICO 9. But FICO 10T was the one that was recommended by the GSEs. And that's because, quite simply, it's the most predictive score in the market for default risk. And in the particular market associated with the FHFA and the GSEs, that's mortgage default risk. And it is particularly great at predicting mortgage default risk. And it does so better than any other the other standard models that are available in the market. And it particularly does so better related to first-time home buyers. And when we think about the mission of a lot of these organizations, it's to enable, and we think about the mission of government in a lot of cases related to federal housing finance policy, it's to get more Americans into homes. And without a doubt, the data shows that the best score in the marketplace for that is FICO Score 10T. And it's not really that close, right? From a prediction perspective, it's double digit better than the competitors on that first time home buyer segment.
I want to double click in why predictive power matters so much and ultimately will benefit not only the lenders and investors, but consumers as well.
Yeah, because in particular in the government sponsored enterprises, the credit score determines where a lender operates from a loan level pricing adjustment perspective. So it influences the price that the borrower will pay for their mortgage. And it also influences things when insurance is needed, and there are other things that it influences. But it's really important that people are accurately scored so that they receive, and this is at the macro level, so that the majority of borrowers can receive the best rate possible for them based on their history of behavior. And without a doubt, FICO Score 10T does that. It really is able to better differentiate risk, high risk from low risk and move more borrowers from middle scores up higher into the scoring range. And those higher scoring range actually align to lower default propensity, and they will get borrowers better rates on their mortgages.
Julie, let me ask you this. One of the things about FICO scores is our what some people call the minimum scoring criteria, the 6 month requirement of having a little bit of data in your credit bureau file to be able to generate a FICO score. Why do you think that's an important number, that 6 month? And why do you think, even though why some consumers might not be able to immediately get a FICO score with less than that of data, it would still ultimately serve them better?
We've looked at it. We, have reviewed where we should or shouldn't make changes associated with this minimum scoring criteria to actually drive the point of a score, a credit score, right? Which is to rank order risk associated with the macro population, related to the propensity to default. And so we studied it extensively, and we know that you can't do that as well if you don't use the minimum scoring criteria, which for us means you have to have had active trade lines and that you have to have had a trade line open for at least 6 months, and that you can't just have things like derogatory information on a file with nothing else to be scored by the FICO score. And why is that important? Well, people who only have derogatory information on their file are not going to get high scores. And that's not just true for the FICO score. You see that in competitor products where those types of potential borrowers are not scoring at thresholds that are generally approved for lending products. And then the other segments are really new to credit segments. So these generally do skew from an age perspective to a younger demographic who's new to credit and first introducing themselves to products like credit cards or personal loans that are small value. This is what we generally see when we look at the data. And those types of products or services are really the stepping stone that people generally introduce themselves to from a credit perspective before they move on to larger products like auto loans and mortgages, which generally have much higher value associated with them in terms of the lending balance. And then a third area where generally our minimum scoring criteria doesn't include this segment of the population would be those who have removed themselves from needing or accessing credit. And so a perfect example of this would be my father. He pays for everything in cash, right? He's 83 years old. He knows Jim at the gas station and pays with cash, right? And goes and visits his banker every day because he wants to get out of the house and gets his cash, and he moves around and he just doesn't use, his house is paid off, his car is paid off, all of this stuff is paid off. And so, he's in that enviable position of enjoying his retirement and just not wanting to access credit because he has what he needs and he's not consuming a lot, and he just he doesn't go places where only credit cards are allowed. He doesn't fly, certainly, so he doesn't need a credit card, right? And so these are the things, this is another segment of the population. People have removed themselves from wanting access to credit, who are no longer actively seeking credit. And in that population specifically, we can confirm that because when you look at it, you see that 4% or less of that population actually seek credit. And so when we look at who does the FICO score not score, it really segments out into those kind of three areas because of our minimum scoring criteria. And the balance to that is because we have that minimum scoring criteria for those who are seeking credit, we're able to more accurately score them, which enables all of those borrowers who are seeking credit to actually get themselves into the best terms if they're credit ready. And so we think in the balance of scoring more or scoring more better, scoring more better is where you need to actually shift your balance when you're building a score. And that's absolutely what the FICO score does. And that's why the FICO score has minimum scoring criteria.
If there's one thing you'll know about Julie, the more we have her on this podcast, is that you'll meet all of her family members. Her brother, who uses BNPL, now we know her dad might not be using credit as much. So,
yeah, he's like, FICO score, what's that? I don't have to care about that anymore. I'm too old for that.
Julie, I want to bring up a topic that just about everyone is talking about, and that is AI. So, when it comes to AI and credit scoring, where does FICO stand?
Yeah. So artificial intelligence is not used to calculate the final um, FICO score. From a FICO score perspective, it's really important that everything remains explainable. It's important that everything aligns to fair lending standards. It's important that no data is used that doesn't align to those standards. And to enable that and to make sure that the FICO score is 100% aligned to that, the FICO score itself is not built, the final score, with artificial intelligence. That said, we extensively use machine learning in our development processes, in our testing processes, and in a lot of different cycles on the back end before we actually build the final delivery of the FICO score, right? There are over, gosh, the last count, there were over 100 projects within my team that were using AI to actually help us be more efficient, to enable our customers to make better decisions, and to deliver things more quickly to the market associated with the FICO Score product suite. But the FICO Score itself, in order to make sure we continue to stay strictly aligned to fair lending standards that our customers have to meet, and to make sure that no bias is introduced associated with those standards into credit scoring from a FICO score perspective, does not itself in the final product use artificial intelligence. Now, FICO themselves, though, is a pioneer in artificial intelligence, and that's why we can so effectively use it outside of that last final product. We are a pioneer on our software business. We are pioneering a lot of use in our scores business. And I don't know if you know this, Kristina, but I also own a patent that includes artificial intelligence. So, from my time at FICO when I was in the software business. So if anyone wants to know how to predict electrical grid failure, I can help you.
Credit scoring or electrical power grid failure guru? I had no idea, Julie. We need that's a
Keep me on
story
your
for another.
toes.
I love it. Moving to the segment that we're actually going to carry from podcast to podcast. This one I'm very excited for because one of my favorite things to do is busting myths. So before we wrap, Julie would love to give you the floor to bust a myth, something you hear repeatedly, something that you see online, anything that just you're ready for that rhetoric to disappear.
I can't just give you one busted myth because I need
I
to bust
knew,
a
I
couple
knew
of
that.
myths
Yeah.
that really bother me, right? So that all credit scores are built the same, and that if you look at a score, you can compare scores directly. You can't, right? At the end of the day, we look at a macro population, we segment that population, and we build a score that will then distribute that population associated with a risk outcome measurement. And we do that based on a very specific recipe. And so what that means is if you're looking at a 700 FICO score and you're trying to compare it to a different credit score, whether that be Vantage Score 4 or whether that be something else, and you think you can compare a 700 and a 700, you can't, because they simply don't mean the same thing. They're not scaled the same way. They're not built the same way. And how they will actually distribute that macro population of borrowers will be very different. And this is very clear when you look at analysis from research firms like Milliman and AEI that show in a lender choice world, which we also call an adverse score selection world, you will drive up defaults by using two different score types because you rank order that macro population differently. So credit scores are not the same. They don't work the same, and they won't get you to the same outcome. So using only FICO scores versus using FICO and other scores don't get you to the same default outcome. And that is easily proven by looking at any of the data available associated with big populations, including the data that's been released by the government-sponsored enterprises looking at FICO Classic, FICO 10T, and Vantage Score 4. So that's one myth I absolutely have to bust. Please, people, understand. You got to understand how the scores work at a detailed level. You have to really and completely analyze that, and you can't compare them at only the score. You have to look at the outcome of the score at that point, which is the propensity to default. And then another myth that I am going to bust.
You got one. You got one.
I got to do two. Is that you have to have a lot of debt to have a FICO score. That is simply not true. And it makes me want to pull my hair out when I hear it. It's just not true when I hear it or I read it or I see it on TV. I want to scream at the TV. I scare my dog. I mean, it's not good. It's not a good situation. The reality is that we actually see that that's just not what the data shows us in terms of high FICO score individuals. You don't need a lot of debt to have a high FICO score. In fact, we see our highest scoring populations frequently don't have significant debt from a credit perspective. And so it's just not true. I don't care what pundits, popular pundits may tell you that are related to budgeting. I won't name and shame. It's not true. So.
Okay, transitioning to the last part of the podcast. Every podcast, we will end the exact same way. The final word, it is yours, Julie. The floor is yours.
Yeah, so thanks so much, Kristina, for having me on the podcast. I tease about maybe not wanting to do this. I just think other people on my team will be so much better at this in terms of being guest on your podcast. But I do appreciate the team's work. I hope that all of our audience will find the content that we're putting out to be valuable. At the end of the day, it's my job at FICO to make sure we're building and delivering score products that our customers and their customers can trust. And what I will tell you is the content we will give you on this podcast will be content that you can trust. And we will continue to do everything in our power to build products that you will be able to continue to trust, because that's our job.
Thank you, Julie. All right. Thanks so much for joining us, Julie, and being the very first guest in the hot seat. I appreciate it. For the audience, thanks so much for joining us and for listening in. As Julie mentioned, we're going to be continuing this on a monthly basis. So be sure to follow along wherever you get podcasts, including our LinkedIn and YouTube channel as well. Until next time, keep asking those questions. We will bring you candid, truthful, and trusted answers, and we'll keep the conversation going.